I've noticed not a lot of people are talking about the elephant we have in the room. And since nobody wants to be talking about it, I think I'm going to do it. So, as you can see on the screen, we're 22 hours away, just about somewhere below 23 hours away from the next FOMC meeting. And as you can see, well, according to the CME tool, it's pretty evident. And plus, at this point, I think even a blind person understands and knows, and somebody who is completely unaware of the market understands that we're not going to have any rate cuts on this upcoming FOMC. The only question is whether the Fed are going to be more dovish or hawkish looking forward on to the upcoming meetings. Whether they're going to do anything on May or June. I think we have the next meeting. The relevant meeting is going to be discussed is going to be June, of course. On according chart right now, you can see is that they right now these things this tool I'm not gonna say I'm a big fan, but it readjusts every now and then, and that's why it ends up being more accurate than not most of the time. It simply adjusts as we go. At the current time, you can see some assumptions, 55.3% do assess that we will have a rate cut around the June meeting. Of course, we're gonna have them potentially decrease 25 basis points. That's the assumption. But as I've said, there is this elephant in the room we need to talk about, and I want to talk about it a little bit. It's the U.S. oil, and quietly, while people were not noticing or paying attention, oil has risen up to $82.71. And as you can see, according to my chart, and it's merely my analysis, again, not financial advice, it's just my opinion, if you will, and the way I analyze the market, and I'm sharing with you my thoughts about it. So I like to look at most assets. They start looking at them from the monthly point of view. I have various supports and resistances here, as you can tell on the screen. I've verified that they are very correct and accurate. I'm not going to break that down right now. As you can tell, we're running through a channel, and right now we're basically hitting the head of the price action, the top, the event horizon, the edge of the price action is having found resistance or what was support earlier, but you can see this resistance was tested before. We've been trying to break this resistance for some time now, although it shows 82.70 dollars at the time being. In reality, if you check out today's price action, you will be able to tell, or just simply by looking where this wick goes, we went as high as $83, which I'm gonna let you in on a tiny little secret, matches with JP Morgan's Jamie Dimon short-term price target on oil. That's something that we spoke about in the community. Shameless plug, I'm going to talk about the community a little bit more in depth at the end of the video for those who are going to stay, but let's focus here for the time being. So, as I said, and as most of you know, and again, something that has been shared in the community quite a bit and for a long time, and I've been saying that I'm expecting a correction on the overall indices. But the place where the entire avalanche could start would be actually oil, and oil being elevated as is, and the more oil basically goes higher, the more elevated oil is, the more it will affect anything and everything. I'm talking about all the consumer goods, I'm talking about shipping, I'm talking about anything and everything. And the way most people are familiar and know that oil at these levels, even at 70, is an exorbitant, very high price that tends to affect consumer goods and the overall supply chain in various ways. It starts to cut into the profit margin of various companies. Hence, that little gap basically is being transferred to us, the consumers. We result with higher prices, and higher prices in these inflationary conditions, let's be honest, are not great. Let's also talk about inflation. If we're looking at the current year-over-year inflation, it's 3.2 that rose from 3.1 in the previous month. But if we're looking at core year over year, the most of you know that we're actually looking at 3.7%. Unlike a year ago, which was 5.5. But if you ask the average American consumer, they will tell you it feels to them as if they're experiencing the whole 9% that we had during the peak of COVID. And if they were able to keep these numbers tame for now. And if we're not neglecting to look at the fact of the matter that at the beginning of COVID, we were talking about how the average consumer sort of survives because they have a lot of savings. Now those same consumers are in debt and actually are using um, credit and buy now pay later services to buy groceries, which is already a bad sign. But if you think about it for a second, all these people technically are paper rich. Why? Because, well, a lot of them, a decent amount of them, do have a lot of money in the stock market. So for them to sort of survive the next leg of things, they can actually liquidate their profits from the market. But as you can imagine, liquidating profits from the market can start an avalanche effect. Now, if we want to talk about oil and energy in particular, the oil in particular is something that affects CPI, okay? And as we know, CPI is already elevated and we're feeling as if it's more elevated. But if CPI will go out of control because oil will continue appreciating in price and actually continue running, in my assessment, oil can go as far as, yes, this 95 target, okay, 95.08. Let's not be particular. Of course, there are plenty of supports and resistances that will have to be broken on our way there. But if we will, in fact, already crossing the 80 level, in fact, crossing already the 80 level, we're already going to see effects on the next CPI report. So, let alone people talk about again how the Fed. I think people are going to be highly disappointed on this FOMC meeting because again at this point it's pretty evident they're not going to cut rates. But if things will continue down the path that they are, as I'm expecting them to, and various other people that are far smarter than myself, and with all due respect to the Tom Lees of the world, the perma bulls and all that, and they are right. Essentially, at the end of the day, I am bullish on the overall market, and I do agree that at the end of the day, overall, the market will correct upwards, and we will see better conditions with time. But for the time being, people often like to refer to the soft landing scenario. So I would kind of like to bring people back to earth and say, well, if we want to stick to analogies, I'm going to say that, well, we're still up in the air. Our engine is no longer up in flames, okay? But we definitely haven't. We're not yet at the soft landing bit. For me to experience a soft landing, first we actually need to land. At the time being, we're nowhere near landing. Okay, so in my assessment, if oil will continue increasing upwards and we're going to see worse CPI prints, increasing CPI prints, instead of conversing about cutting rates, like my previous videos stated, I'm expecting the Fed potentially to actually hike rates. And I know it's not a popular opinion, and remember, it does not come from somebody who I'm not, a Michael Burry. I'm not definitely not bearish or anything of that sort, just the opposite. And I'm not even bearish as much as I'm saying there is a necessary process here that has to happen, and it starts to become more evident through technicals, starts to become more evident through fundamental events. The more we go, the further we go, the more evident it becomes. Now, in my opinion, if we are going to have a correction, and just kind of to give you a little tidbit to, again, it's not a financial advice, but it's more about what I'm doing. I'm currently focusing on the Qs, which most know are a derivative of the Nasdaq. Um, and I will tell you this: look, based upon what you can see here, you can see, give or take, the first leg of the correction that I'm expecting on the Qs. So the way I'm basically hedging the market, I am buying, loading up on S triple Qs according to this chart. As you can see, again, various supports and resistances. Currently, we're below a very major support. We broke various supports and resistances on our way here. You just don't have them on the chart right now, not to make it cluttered and noisy so you can see things. So what I'm doing is I'm loading up on S triple Qs, a derivative of the triple Qs. Basically, it's triple leveraged. And if I'm assessing correctly, there are roughly about 200% profit here to be taken off the table quite easily. Yes, I'm looking at the at least as a first checkpoint, that 33.05 area. That 33.05, given the current price, will give you a decent ROI. So I'm looking at that. I'm actually loading up on this. Again, this is not financial advice. You do you, right? That's the way I handle the situation. And if you have a lot of assets, if it's Nvidia, Tesla, Apple, SoFi, Palantir, doesn't matter, all of the above. Most of whom I just mentioned are great companies and have great future ahead of them. I'm tremendously bullish on Palantir, tremendously bullish on Tesla. Um, Overall bullish on Nvidia, not at these prices, but I'm not going to break it down in this video. You have dedicated videos to Nvidia that I've done before. You can look through the library of videos I have and see my assessment and understanding of where Nvidia is going, and certain things or lack thereof, signs that say that even the market makers understand, including the Nvidia and themselves, that the market will go for a correction. Hint, lack of a split and various other things. But again, I'm not going to deviate on this. So, in my assessment, there are ways to prepare for an upcoming correction. In my assessment, the correction is going to be far deeper than people expect. That's pretty much it. And yeah, if I can already have your attention for just a couple of seconds here, here's that community that I've mentioned, the way you can access it. There are various ways, of course. You can just uh, join our community. We also have a free segment, a public segment. Right now, what you're seeing is basically our members segment. You can also see here my little tidbit of investory. Here I have my personal community. I have my members. We share and talk about technicals most of all, more than anything else there. We have various chats that discuss anything from options trading to Tesla itself, Palantir. We, of course, have Tom's Stock MVP dedicated channel here. Commodities, crypto, anything and everything. We talk about geopolitics. We share geopolitics articles, tabloids, finance, technologies. As you can see, just the other day we crossed the 7,777 members. So we're doing quite well. Of course, everybody are more. We have here Bloomberg Radio, various voice chats, and various events that we're conducting all the time. So, of course, all of you are more than welcome to join our humble community. And here I'm going to show you real quick. We also have a public part right here, that basically is a microcosm, kind of a micro structure of the overall Discord, right? It's just that it's free, of course, but it has roughly the same sort of things that we offer for our members. Our members, of course, get a little bit more. The way you can get to either or one, it's discord.gg/Tom Nash. Yes, I share my Discord, as you can tell, with Tom Nash. We're close friends. In fact, my entire channel is in existence thanks to him, basically, to sum it all up and keep it simple. And yeah, that's another way you can join our Discord, and you can join my Discord via Patreon. It's only $5 a month. That will give you a backdoor into Tom's Discord and will allow you to see what I think, and will be in the loop, sort of be up to speed and in the know of my expectation of what's coming up in the market in the upcoming months. And that's it, pretty much. I'll tremendously appreciate it if you drop me a like and subscribe to the channel. That way you'll always be able to be up to speed on what my thoughts are on the market. And have a wonderful week, everybody. Cheers.